of you online have had an opportunity to participate in some of the dynamic discussions and opportunities both yesterday and today. The purpose of this forum is to address issues that are keeping you up at night, or issues that you may not be aware of yet that will be keeping you up at night. The economy is an ongoing issue and is ever evolving, which makes its impact always an emerging issue on housing markets.
I know most of my clients are asking questions about what's to come, or why is the market behaving like this? So, we're excited to provide you with perspectives on the national economy as well as Missouri's economy.
We have two highly regarded economists that we know are great historians. We will note their prognostications today for later evaluation. Both will provide opening remarks, followed by, as I like to call them, interrogatories, that I hope you find interesting and provocative, arming you with the latest information to assist your business decisions and advise your clients. Michelle?
Jeff Pinkerton serves as Director of Economic Research for the Missouri Department of Economic Development. In this role, he monitors Missouri's economy and advises economic developers and state government leaders on global, national, and regional economic trends. Jeff's research focuses on state and regional economic competitiveness. Prior to working for the state of Missouri, Jeff served as a senior researcher for the Mid-America Regional Council in Kansas City. Jeff holds a master's degree in economics from the University of Missouri, Kansas City.
Dr. Lawrence Yoon, our other speaker, as most of you know, is the chief economist for the National Association of Realtors and supervises the research and publication of reports to NAR's 1.4 million members. As such, he is often asked to participate on panels, provide forecasts for real estate, and testify before Congress. He received his undergraduate degree from Purdue University and his PhD from the University of Maryland at College Park. So we'll start with Dr. Yoon today. Since all of you were here, you may not realize that, as predicted, the Federal Reserve raised the federal funds rate again today by 3/4 of a point. I'd like to start with a quote from Lawrence. He said just recently, "We're witnessing a housing recession in terms of declining home sales and home building. However, it's not a recession in home prices. Inventory remains tight and prices continue to rise nationally, with nearly 40% of homes still commanding full list price." So Lawrence, are we in a recession? Are we in a housing recession? Please share your outlook.
Hello, everyone. Thank you for inviting. I am assuming that the technology is working fine. I am here in Washington, D.C., few blocks from the Federal Reserve, where they raised the interest rate by 3/4 of a percentage point, and they are planning to do so again in November. Same large increase, and probably another one in early 2023. So we are not done. And mortgage rate increases are certainly causing difficulty in the housing market. I have a brief time, but even in this brief time, I speak a little better with PowerPoint slides, so let me put that onto the screen. So hold one second. All right, so I think you can see the screen. This is the 30-year fixed rate mortgage from 1990. And what I illustrated here is you see the general declining path that has been occurring over the past 30 years. And then I put that little red line. So red line is what the financial market momentum players look carefully. So it doesn't have to do with any rationality. It could just be due to the momentum and everybody behaves similarly. So what that resistance is, once it begins to touch that resistance, then it generally retreat back, because resistance is a hard, like a rock, a solid wall, hard to penetrate. But once it is penetrated, once it is punctured in a sense, then it can really begin to move higher. So what I'm illustrating this is that there was a resistance point essentially established at around 5% mortgage rates. And as we know, we are at 6% mortgage rate already. So it punctured the 5% mortgage rate, and now it's beginning to test the second resistance point, which is right in the middle, which is about 6.2%, 6.3%. So we will be testing that. And I'm hoping that it holds and then mortgage rate retreat back down under 6% and hang around at 6% for the rest of the year and even in most of 2023. But if somehow it punctures that second resistance, then it could go up to above 8% rate, which will be quite alarming condition, not only for you, but for your clients' condition. I mean, one can almost think of this as a battle line between two armies that they are fighting back and forth. But once it is punctured, there's a large advance quickly that occurs. So it's going to test that 6.2% mortgage rate and let's hope that resistance hold. Now, in the meantime, the mortgage rate, which is the red line, generally follows the 10-year Treasury. So when the Fed raised interest rates today, it impacted the short-term rates. 2-year Treasury is going wild, way up. But mortgage rates are more influenced by the 10-year Treasury, and 10-year Treasury really did not move all that much from the Federal Reserve announcement today, because people think, well, once inflation is contained, Federal Reserve maybe sometime next year, second half of next year, may be able to reduce interest rate. So if the inflation is contained, that's a possibility. So 10-year Treasury really did not react too much to today's short-term interest rate hike. So again, the mortgage rate, let's hope it meets the resistance and it doesn't puncture that resistance so that it can come back down under 6% mortgage rate. But in the meantime, as you know, home prices have been exceptionally strong this past 2 years. As Daryl mentioned, we are in a housing recession in terms of fewer building activity. Mortgage lending industry is cutting staff. And the realtors, you have far lower income now, commission income now than before, but your past clients who bought a property with you this past 2 years, they are smiling big. They locked in at those 3% mortgage rates, and they are getting this price appreciation. The same client that you served last year, in a sense, they will be unable to buy the same home they are living in today at 6%. Many of them will be unable to purchase. But they are very thankful having worked with you and purchased, getting this wealth increase along with locking in low payment. But because of the higher mortgage rates that we have experienced throughout this year, the pending contracts has been coming down. We had a fresh news release this morning, which showed a 7 consecutive months of sales decline. No surprise, the most sensitive and the most immediate response to the changes in interest rate policy is the housing sector. When I study Econ 101, they said Federal Reserve changes monetary policy, and we will see the results of those policy probably in 1 year or in 18 months. That's what the textbooks say. But the housing sector pretty much respond immediately in terms of the economic impact. Now, the financial market always goes wild just from the rumors of the Federal Reserve, but excluding the financial market, the most immediate and sensitive sector to changes in mortgage rates, interest rate is the housing sector. Now, here is a data across the MLSs in the past 30 days. What we are finding is that half of the home, 51% of the homes are still being sold at or above list price. This is not a soft market. For home buyers, this is still a tough condition. Nonetheless, 49% of the homes are being sold with price concession. Look at the very last column on the right side. So it shows for homes that actually close, how many days did it come on the market before contract was signed? So on the homes that already closed. So among those homes where they did provide some price concession in the first week through price negotiation, it was 4.6% price concession. But as the days on the market lengthens, say up to 2 months, 60 days, the price concession is 8 to 10% price concession. And if it's 120 days, price concession is 14.9%. To illustrate, you need to talk with your home sellers, make sure you price the home correctly on the first go. Otherwise, it's going to sit on the market. And once it sits on the market for a long period, this is roughly what the price concession is required. The other columns are not closed, either active or pending, and then the price shaving is actually a little modest. Maybe that's why it's not closing, because you need to have a deeper price concession to get the closing done. In related to the job market, Missouri, right in the middle of the country, it shows 0.6%. And what does 0.6% mean for Missouri? It has 0.6% more jobs in the latest data compared to March 2020 when that ugly COVID arrived. So Missouri is on the positive side, unlike, say, Kansas, which is minus 1.5, or Illinois, which is down minus 0.4. Generally speaking, it's color-coded. Blue color states, more job creation. The leading states, Utah, Texas is doing well, Florida is doing well. States that is not doing well would be New York, Louisiana, Alaska, Minnesota. So those are some of the comparison, but Missouri is on the positive side. And also in terms of the long-term job situation in Missouri, these are W-2 statement salary jobs. So it's not realtors commission income jobs, but salary job with W-2 statements over a past 22 years. And you see that little fluctuation occurring, but you reached an all-time high right before COVID. Then you really went down during the lockdown, but now you have surpassed the pre-COVID condition. So now record high number of jobs in Missouri. Important considering mortgage rates are high. So how do you get a new set of buyers? Job creation, job creation. That is what is needed. For the short time frame, let me just move quickly. Inventory levels are very low. Look at the middle of the graph. When the inventory levels are 4 times larger than today, this is when the prices really sink. So right now, we are fewer buyers, but also fewer inventory. I mean, the inventory is increasing, but it's only very modest increase. And many home sellers are loving their 3% rate, and maybe they are unwilling to list their property because now they would face 6% mortgage rates. My final slide, just on the outlook, is that 2019, the very first line, pre-COVID, somewhat boring, no increase in sales, price increase of only 5%. Then in 2020 and 2021, exceptional performance, thanks to record low mortgage rates. Now that the mortgage rates are higher, 22 forecast is that I think the home sales for the year total will be down about 13 to 18%, depending on locality, but the prices will still be up. So the dollar revenue on the most optimistic scenario is that it's going to decline only 2% dollar revenue. On the pessimistic side, dollar revenue may be down about 10%. And next year, I'm hoping that mortgage rates stabilize. Again, it doesn't puncture that resistance. And then we have job creation so that unit sale may actually squeak out a little gain. Home prices, I don't think it is in danger of any decline. So thank you for giving me this opportunity to share some of my thoughts with you all. And now I'm going to turn it over to either Daryl or Michelle. So back to you.
Thank you, Lawrence. Please stick around. I think we may have a couple questions for you after Jeff gives his presentation. At this point, we'll hear from Jeff Pinkerton.
Thank you, Daryl. We have some slides up here like Lawrence. I'm an economist. I can't speak unless I have some PowerPoint slides to share with you. As I get the chance to go around the state and talk with folks about the economy, the big question I get all the time, the first question Daryl asked me a few weeks ago was, are we in a recession? And on my first slide, we can go to the next slide, please. The other chart is showing retail sales. Retail sales were very strong. You may see in mid-2021, we did see a big spike in retail sales as people started to recover a little bit, people getting out and being more active in the economy. There were some stimulus checks arriving and people spent money. And that didn't come back down since then. And you can see the trend that we've had since 2021 has remained very high and well above pre-pandemic trends. So the consumer is strong, and they are strong despite high inflation. The next slide, we'll change the question a little bit, and we'll ask, are we headed for a recession? And here I get far less confident because I'm going to give you a real solid maybe, because there are a lot of things out there that might indicate that we could be headed for a recession. And we've already talked about one of them today. The Consumer Price Index, inflation, is at levels that we haven't seen since the early 1980s. 8.3% was the last headline rate. And we thought we would see that, or I'm sorry, 8.1 was the last headline rate, I believe. We thought we would see that start to dip down since we've seen gas prices, which have been a major driver of high prices over the last year or so. They've been coming down in the last few months. But what's replaced that has been food and shelter cost, and so we have not seen much improvement in terms of inflation. And I think we saw a Fed today that saw that number with inflation remaining high, and they're going to be very, very aggressive, remain very aggressive in terms of fighting inflation and keeping those rates high, unfortunately. And another chart I will show you is just U.S. gross domestic product. The last 2 quarters have been negative. We had a negative quarter in Q1 and followed up in Q2. And a lot of people think back-to-back negative quarters is a sign of a recession. That is not how we technically determine whether or not we're in a recession, but certainly not a good sign. Let's go on to our next slide here. As a matter of fact, let's go ahead and skip ahead a little bit, because I know we want to get to some Q&A. So how is Missouri going to handle the economic recovery, if we are in one, or the recession, if we are going to dip into one in the next few months? So next slide will show you that Missouri is kind of a middle ground state. We're here in the middle of the country, and our economy tends to perform in the middle of the pack. What we have here are different clusters comparing Missouri to the United States in different segments of time. So from left to right, prior to the Great Recession, 2005 to 2027, we grew 2.1%, but the nation grew 6%. The Great Recession happened. It didn't impact us as much. It impacted us, but not as much as the nation. The recovery from the Great Recession was very robust, 26% growth between 2009 and 2019 nationally, but less than that, 10% here in the Midwest, or in Missouri, excuse me. During the COVID recession, again, negative impact, but not as much of an impact here as it was nationally. And since then, we have a very small recovery since then. It's grown, but again, not at the national level. So our economy tends to not have highs quite as high, doesn't have lows quite as low. But with us in economic development, I'm glad we don't have those lows, but I want to get those highs up a little bit more on par with the nation. If we go to the next slide here, we can see we've had a challenge with that. Our growth rate, our average annual growth rate was 1.1%, so we outdid our Midwestern peers, getting closer to the national growth rates. Venture capital side, the entrepreneurial side, that Missouri just quite frankly isn't competing with compared to some of our other states. So we need to turn that around and make sure we have a strength there. And the third area that I think we need to address on the next slide is the quality of life. And I'm talking to people who sell Missouri's quality of life every day. So you all know that very well. People increasingly now, this is more and more, it's always been important, but it's more and more important now. It's more of an economic development issue now than it ever has been. It used to be that people would go to live in places that were good to work. They would go where the jobs were. But increasingly, people are choosing where they want to live, and they'll find work. And they have much more flexibility with that. So things like parks and trails and cultural activities really mean something to all of us, and they mean a lot in terms of economic development. So we need to make sure we're doing that. And one area that we may see that on the next slide here is population change. This is looking at just general county level. Lake homes have high values, and the population there has a lower median household income. And I believe I have just a few other slides to talk about some housing issues to talk about looking at building permit trends. On the next slide here. This is Missouri building permits, and I know permits don't necessarily equal starts or finishes for houses, but permitting activity was very consistent. Even during the COVID shutdown, people were starting to realize they needed more from their home if they're going to be working from home, and people were able to do that. So we saw permitting activity remain very strong, and we do see a pretty sharp up. Missouri, again, we generally take the middle ground. We have opportunities. Missouri, again, we generally take the middle ground. We have opportunities in this next economy, whatever throws our way, but Missouri has to step up and take advantage of these opportunities. And again, quality of life is something that you all deal with, and that is an economic development issue, and we need to make sure we maintain that quality of life issue. So with that, I think we have plenty of time for some questions. I want to join the panel here.
Yes, please, join us. We have a seat for you. Thank you, Jeff.
The hot
Thank
seat.
you, Lawrence. That was so insightful. You both, yes. You both hit on many of the questions that we discussed during our pre-conference meetings, but there's a few more questions that I'm sure are on the minds of many of us, and Daryl is going to be posing those questions to you.
Hello. Lawrence, you kind of dodged the question on the recession, and you did talk about the housing recession. Jeff pointed out he thinks we're on a little bit of a slippery slope towards a U.S. recession. Do you feel the same, or where do you think we'll land? And during that period, what kind of inflation rate do you expect us to live through?
The recession, informal definition is 2 consecutive quarters of GDP decline. So GDP decline in the first quarter and the second quarter. So as a economist, say they're in the evening, cocktail party talking, we are in a recession, 2 straight quarters. But we would not know for sure until the official committee. There's a group of people, I think like that, 15 people sitting around the table, and then they look at all the data, and then they will vote yes or no or on whether we have a recession. But they will decide that about 1 year from now, when all this is all over and done. So, it's not that useful information at that time other than for historical perspective. But for realtors and for everyday people who want to know what's going to happen to the economy, whether or not we are in a recession, this would be one of the most bizarre recession of all time, in a sense that jobs are plentiful. There's help wanted sign. You walk around the street, help wanted sign, you visually witness. In a hotel, they're short on staff, they want to hire people, and certainly in the airport, with so many pilots, flight attendants, and the mechanics taking the early retirement because the airline industry thought they will totally crash because of COVID. What do you know? Everybody wants to get back to normal life now. And consequently, the help wanted signs are everywhere. The unemployment rate is very, very low. So consequently, if we are in a recession, it is a very bizarre recession, but still, given that the Federal Reserve will continue to raise interest rates, which means that it will steadily bring the inflation rate down, but inflation rate will come down, as the Chairman Powell mentioned today, with some pain. And the pain is already happening in the mortgage industry where people are cutting jobs. But he actually expects some of the large corporations, whether technology companies, Procter & Gamble, General Motors, to cut people because economic activity will be slower and then companies don't need as many workers. So there will be some little bit of pain.
Well, I have heard that referred to as a growth recession, so because of the job employment opportunities. So I'll let you pass on that one. I'm keeping track of for your prognostications. Lawrence, what government policies do you think have the greatest impact on our on the inflation and possibility of a recession right now?
Well, one of the great impactful policy is something that the realtors constantly mention to their policymakers. We are short on housing. So if we build more homes, apartments, right now apartment vacancy rates are at historic lows. Consequently, the rents are rising, and rising rent contribute to that inflation. And inflation then leads Federal Reserve to raise the interest rates. So if we had built more apartments or just single family homes, whatnot, if we had relieved all this housing shortage, inflationary pressure would be far less. The other part is we understand the importance of green energy. In fact, I am here in NAR DC office building. This is the first green designated building in Washington, DC, when it was first constructed, I think 10, 15 years ago, first green building. Now, since then, there are many other green designated buildings. So green energy is important, but it is very small, less than 10%. 90% of America's energy consumption requires carbon. And many oil companies are saying that, well, what they are hearing coming out of Washington is that they want to kill off oil companies. So if that is the rhetoric coming out of Washington, imagine you are an oil company. Do you want to make that $20 billion investment knowing that Washington wants to kill you? Well, so they are very hesitant to make those investments. Consequently, we are not drilling as much. And if we don't drill as much, we feel it at the gas pump. We feel it at the, running the building, air conditioning, everything. So that also contributes to inflation. So I think we have to recognize over 90% of energy consumption comes from carbon energy. And more we have, it will lessen the price of gasoline, lessen the price of other energy use. So that will also force the Federal Reserve to be less aggressive in trying to raise interest rates.
Okay, I did hear you mention something that I want to come back to, but Jeff, I'd like to ask you, what do you see as far as state policy that may be not the best for us right now?
Well, I think Missouri has been historically a low-tax state, and I think that served us fairly well. We rank usually very high in terms of the business climate, and businesses, like to go to places where, the government interaction is less. So we've been able to attract that type of business. Those type of businesses would be manufacturing, transportation. They're more on a tight, they're on every dollar counts for them, so they're going to look for places where they can cut their costs. And that works for us as a state. What I would like to see in the state is a little bit more opportunity for flexibility from the regional perspective. Can the regions maybe see an opportunity, and they may want to pursue something, from maybe a tax perspective or some type of spending perspective they want to focus in on? Can the state help those regions be adaptable to some of the economic opportunities that are out there? So I showed you the chart with the businesses with the high growth that Missouri hasn't participated in. I know, Kansas City, St. Louis, Springfield, or other parts throughout the state, we wouldn't be able to take advantage of that. But those types of businesses maybe aren't necessarily looking for low tax, low service. They may be looking for more skilled workers and things like that. So I look for an opportunity for the state to provide the basics, and with opportunities for our locals perhaps to explore some of those other areas that may be fruitful for them.
Lawrence, we have two large areas in Missouri that are vacation/rental and second home markets. And Jeff kind of alluded to that with his blue shaded areas on his map. What is the outlook for these markets? Will the demand hold up there, especially if there's a big stock market correction or a continued stock market correction?
Jeff?
Oh, that was for Lawrence.
Oh, that was for Lawrence. Oh, Lawrence, you're muted.
Oh, so sorry, I muted myself now. So the stock market is a very important influence for vacation homes, because people who buy vacation home tends to be more on the upper middle class or wealthy individuals, and they have money tied up in the stock market. So stock market goes up, they feel wealthier and buy vacation home. Stock market has come down this year, and therefore people do not have the financial resources or comfortable financial resources to buy vacation home. However, Our monthly sales information we came out today shows 7% of transactions were classified as vacation homes, meaning that we asked realtors, you work with your clients, they bought a property, how would you classify it as it? Is it a rental property, primary occupancy, vacation home? We give options. 7%. That is historically high. So what this is indicating is that given the flexibility of office workers to work from home, I think the days of coming to office 5 days a week, it will not happen. It doesn't matter what the CEOs will imply. There will be tremendous worker resistance. There will be some type of hybrid. So if we accept the fact it is some type of hybrid, then we are going to go into a new paradigm. All of us have 2 cars in the garage. Well, you can easily envision an extended family having 2 homes. Extended family, meaning the brothers, sisters, uncle, to say that, well, this week I'm gonna work from the vacation home. It's much more pleasant to work from vacation home with the internet connection. Then next week, my sister can use it, and the following week, the uncle can use it. So not everyone is working from office, but among those office workers, they have greater flexibility to use vacation home, and consequently, I think among the extended family, having that second home will be a normal thing in America going forward. We are in that transition, so I think steadily we will see. So if you're in the vacation resort area next to the lake, I feel good. I would feel good about that condition.
Okay, so one of the questions I wanted to come back to from your previous comments, what is the current housing inventory supply? And you may have touched on that. Is 6 months inventory still considered equilibrium? 2 economists that I spoke to in January of 2020 suggested that there was no inventory shortage, but rather an inventory displacement, meaning, there's houses available here, but nobody wants to live there. So that's an example of inventory displacement. Despite an inventory shortage, quote unquote, 2021 saw a record for number of homes sold. E.C. Romem from UC Berkeley during NAR's December economic forecast suggested that there was not an inventory shortage, but rather a technology compression, or in his words, a tech speed up. Record sales of last year seem unsustainable as buyers fade away due to affordability exacerbated by higher interest rates. With birth rates declining, a continued trend of and a need for multi-generational living, and that is also exacerbated by the increased inflation levels. It's causing more multi-generational living. And also take into consideration the silver tsunami. Not that I would say I'm part of that group, but...
But you are. Sorry.
But, that will contribute to people moving into different housing situations. And, of course, as people die off, you'll have houses available. So is the housing shortage as dire as NAR portends? And just to throw in a little extra, how much does illegal immigration skew the numbers?
When we say there is a housing shortage, people in the Kansas City area, St. Louis area, right in the middle, Springfield or Columbia, they all told me there is not enough homes for sale throughout last year. If there was more inventory that can do more business, more people will become homeowners. It's not only Missouri. You go to Dallas, Texas, you go to the Florida markets, there's a housing shortage in Martha's Vineyard. So there is a housing shortage all across America in terms of lack of available inventory, especially more on the lower price point where there would have been a ready buyer. Now, 6 months supply was generally considered to be norm because you look at the historical average, it looks like that's where the number is. But nonetheless, we have a better technology. As you know, your clients are doing much of the initial search on their own through the website like Realtor.com and others, doing their own search. And at the more final stage, then they're doing the actual physical visit. So because of the technology improvement, the actual home buying process has shortened in a sense, or ready to move immediately once the home is available. So I would say 6 months is no longer the norm. Probably 4 months or even 3 months could be the new normal. We have to wait and see. And the reason why we have to wait and see, or why it was considered 6 months was considered normal, was when did the home prices rise? Home prices generally rise roughly in line with consumer price inflation, meaning 3 or 4% a year. That was associated with 6 months supply. Now, home prices, as you know, are still in the high single-digit appreciation, which is implying there's still lack of supply. And across the country, at least late last year, early this year, 20% price appreciation. Those are sizable. I mean, those, to say that we don't have a housing shortage in that 20% price growth, I mean, those would be misnomer. So our data this morning when we came out, we had 3.2 months supply, 7% price appreciation. So the new normal may be 4 months. So what I'm looking for is, when does the home prices rise about 3, 4, 5% a year, and that would be the more normal condition. But Daryl, you are right in terms of lower birth rate, but even with the lower birth rate, US population is rising. And how much is illegal immigration is contributing to that? I mean, obviously, this year is far higher than in the past years. People need some place to live. So all this is creating housing shortage. So you look at how many new construction to house new Americans, as well as the immigration, both legal and illegal. I would say that we are still in a housing shortage condition.
Okay, so I want to...
Maybe if I could, Daryl, real quick, anecdotally on that. Going up and talking to folks around the state about their economy, and I'm up in the north area, and the area population there is flat at best and declining in most places. And I asked them about what their economic issues are, and housing always comes up. And this is a place the population is not growing, but they need housing. Anecdotally, the county was trying to attract a manufacturing plant, and in doing so, they're going to have 6 or so managerial positions. There was not one home that was built in the last 30, 40 years that was management position caliber home. So this is, if you look at the population, look at the demographics and say, well, this place doesn't have a housing issue. They do. It's pervasive.
So as a follow-up to that, one of Governor Parsons' priorities is workforce development in Missouri.
Yes.
Which do you think, excuse me, has a bigger economic impact, workforce development or adequate/inadequate workforce housing?
Well, that's a great question. Pick one of those. I think you have to have the housing, and probably because I can be wishy-washy on the development side, but the housing has to be there, or else you can't get the workers to the jobs. So I would, if I had to pick one, I would definitely pick a housing strategy. We got to solve that, and then we have to be a little bit more creative on the workforce training part, and we have to be adaptable. So when we talk about workforce training, it's difficult to say we're all on board for this program. Let's do this program. Let's train this number of people for this skill, because that skill could be out of, not useful in a matter of months or years. So we have to build a workforce training system that's more flexible and more adaptable. So I'll stick with the more structured housing as the most important part of that equation.
Okay. Sorry. Had a thought and I forgot it, but I'll just pass.
It'll come back.
Yeah, it'll come back. So, Lawrence, because we're running out of time here, I'm going to combine 2 issues that I mentioned to you. In some areas of Missouri, investors are purchasing as much as 3 to 4 I know what it was. What do you see realtors, what do they need to do? What can we do to help with economic development in the state?
The real estate investors, first, many realtors are small-time investors. There's, our data shows about 1/3 of realtors have the invested property, part of their retirement planning in a sense. They want that steady rental income even as they leave the business. So we always have some degree of real estate investor in the field. I think the concern is really over the Wall Street funded real estate investors, the institutional investors coming in. Some are just temporary, like iBuyers. They are buying, but they're selling at the same time. I mean, they're losing a lot of money in the process, but they think that they want to do it. So you have some temporary people who buy and quickly sell, so they're not really reducing inventory. They are just participating in terms of buying and selling quickly. And then you have the Wall Street-backed institutional investors who are buying single-family neighborhood with the intent of renting it, which means that you are preventing home ownership. So you are creating a rental society while one is collecting rents. So the Wall Street companies are collecting rents on those properties. Now, it's hard to stop the Wall Street from doing that in our free society where people are chasing after money opportunities. So they want to chase that, you say yes. But one thing that we have been talking to the policymakers, and this is actually generally due to the feedback that we get from realtors as to the conversation, which is we have been speaking with congressional staff who then talk with their members of Congress, and they get, that is an intriguing idea. So what is this intriguing idea? At a time when Wall Street companies are buying up and gobbling up the property, we have mom and pop real estate investors who may want to just essentially cash out. They have seen price appreciation, but if they sell it, they know they're going to be hit with a capital gains tax. Now, of course, they can do 1031 exchange, but some people do not want to do 1031 exchange. They just want to get out of the situation. So lowering the capital gains tax, even temporarily, may provide more inventory to show up at a time when Wall Street is gobbling those inventories. So in a sense, so that we can assure that the inventory situation do not get depleted because of Wall Street. Of course, it has an impact on federal budget deficit and whatnot, but we still are sharing that information with policymakers, and they are nodding, but given this is a midterm election time, no one is moving on it.
Lawrence, thank you for reading my cue cards. The part that you didn't answer, though, institutional investors currently are said to own about 2% of our housing stock. And we have been, since 1963, we've been in a range of, I think it's 65%, 66% to 69.5% home ownership rate. Oh, excuse me. NAR has always said that institutional investor ownership is statistically insignificant. When does it become statistically insignificant? Significant.
So overall ownership of institutional investors who are buying single-family property to turn it into rentals, not flipping, turn it into rentals. That is, making up about 2% of all the properties across the country, and in certain cities like Atlanta, the numbers are much higher. And of course, one goes into certain neighborhood, the numbers really begins to pop out. It could be even 30% of the homes could be owned by Wall Street investors for rental properties.
When does it become statistically significant? At what point? Lawrence? Hello? I said, at what point does it become statistically significant?
So right now, nationwide, 1 or 2%, is that statistically significant? You make the judgment. It's still pushing 2% of the population out of the home ownership possibilities. But the fact that they are in the game right now is frustrating some home buyers. FHA mortgage has no chance of competing against Wall Street cash buyers. So you make the judgment. Right now, it's 1 to 2% range, and is that enough, or would the number rise? But certainly, it's causing discomfort for many people.
Okay, thank you. So getting back to the question I was trying to ask you, what can realtors do?
Well, I think a lot of you probably are very involved in your communities, like Chamber of Commerce, Economic Development Association, as business people, but I think you should probably get in there as leaders as well and share your expertise as what you're seeing on the ground as realtors, because I think, from my perspective, the economic development folks, the chamber folks are aware of the housing issue, but you really can bring some leadership and some actual, this is what's actually happening, and these are the real problems that they're probably aware of, but maybe not to the extent. So I would encourage more leadership involvement in your local communities. That would be needed.
Well, I want to thank both of you for taking my interrogatories.
So that's all the time that we have now. Thank you, Jeff. Thank you, Lawrence, for joining us and for the valuable discussion and sharing your insights with us. And Daryl, thank you for your interesting questions. Please join me in thanking our speakers.